It's been said that your portfolio is like a bar of soap. The more you touch it, the less you have. I always try to keep that in mind, and I try my best not to tinker with things too much, but still, sometimes I think changes are necessary. Having said that, I've been doing a lot of thinking, and I need to switch things up in the way that I'm allocating funds in my portfolio, and I'll tell you what I mean in this video. But before we get to that, in case you're new to the channel, my name is Ryne, and here we strictly talk about investing in dividend stocks, which I think is hands down the easiest way to create passive income, and I truly think this is something that anyone can do. So with that said, if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. So up until this point, I've placed a huge emphasis on my taxable brokerage account, which if you've been following the channel for any amount of time, this is the portfolio you'll be most familiar with. Taking a look at this real quick on my dividend portfolio tracking spreadsheet, which you can start using for free. There is a link to download this spreadsheet in the description of the video. Right now, this account is valued at about $52,500 and is currently bringing in just under $2,300 of annual dividend income. Now, along with that, I think this portfolio has some pretty well-rounded dividend stats. It's got about a 4.6% dividend yield, which is very nice, and a pretty respectable 5-year dividend growth rate of 6.75%, which I think is pretty good considering how high the yield is. In this portfolio, I have 21 different holdings, all of which I have hand-selected, and if we scroll over here looking at the returns, overall, I'm doing pretty good. I'm only down on a total return basis on 2 different positions, both of which are the telecom stocks in my portfolio, AT&T and Verizon. Furthermore, looking at all of the positions I've sold out of over the years, at least since I started sharing this portfolio here on YouTube, this isn't too bad either. I mean, I've taken some L's on some of these positions here, at least in terms of share price, but on a total return basis, I've only lost money on 2 of them, with 3M here being my biggest loser by far, but still in terms of dollars, I'm net positive. Overall, I've made money, so I think we've done pretty well. Now, with that said, despite how hard I've tried, I clearly don't have a 100% win rate with the investments I've selected, which is fine. I'm pretty happy with what I've been able to do so far, but I can't necessarily call this portfolio yet a work of art, because really, more than anything, it's just a work in progress. As am I, by the way. I started investing a few years ago with no experience whatsoever, and so I like to think of this portfolio as a reflection of my evolution as an investor so far, and that's one of the reasons I prioritize this portfolio over my other one here, which is my Roth IRA. I started this portfolio back at the start of last year, and as you can see, it's a lot smaller than my main taxable brokerage account, coming in at about $5,700, and this portfolio is only generating about $160 of annual dividend income. And with that, the dividend stats look a lot different than the taxable account. The yield here is lower, coming in at about 2.8%, with a 5-year dividend growth rate that is considerably higher in the double digits at about 10.7%. And as you can see, the portfolio setup is so much more simple. It is so much more straightforward than what we'll find in my taxable account. There's only 2 ETFs in here. We have SCHD and we have VU, and every single week I just dollar cost average into these 2 ETFs, rain or shine, no matter whether they're up and down. I just put money into them no matter what. Now, the popular consensus is that you should max out your Roth IRA before you contribute to your taxable account, with the reason being because you can withdraw money tax-free from your Roth IRA once you reach the age of 59 and a half. Well, that's obviously not the case with the taxable account, but I had been doing this backwards. I chose to prioritize my taxable account over my Roth IRA because I've always planned on retiring before that withdrawal age, 59 and a half, 60 years old. And with that said, I do think that the Roth IRA versus taxable account can be a nuanced conversation. But as I'm getting older and am thinking about this stuff more, I'm coming around to the idea that this way of thinking, for my situation in particular, has been a short-sighted approach to allocating the contributions in my portfolio. And with that said, I'm going to change things up, and starting now, I'm going to reduce my weekly contributions to my taxable brokerage account in order to max out my Roth IRA. So here's what my contribution situation is looking like right now. Every single week, I invest $150 into my main taxable brokerage account, with only $65 going into my Roth IRA. And actually, recently, I just bumped this up from $50 per week to $60 per week. But now, as it stands, I'm investing $215 every single week. But after making this change, I think this is looking a lot more well-balanced. The contributions to the main account will go from $150 per week down to $100 per week, with the contributions to the Roth IRA doubling every single week, going from $65 to $130. And in total, this is actually going to raise my weekly contributions by $15. I think this is going to be a good way to divvy up my contributions moving forward from here on out, and actually forecasting the future value of my portfolio by the time I'm 59 and a half, 60 years old, 30 years into the future. This change is actually going to have a real positive impact on the portfolio as a whole, both in terms of overall value 30 years down the road, road, but also my dividend income as well. So if I were to just keep my contributions how they have been so far, prioritizing the main taxable brokerage account, this is what the situation will look like 30 years down the road. The main account will be valued at about $1.9 million and will be generating $121,000, with the Roth IRA coming in just under $800,000 while generating a near $40,000 of annual dividend income. And with these both combined, we're looking at a $2.7 million portfolio value and about $160,000 of annual dividend income, with 76% of this income being taxable. Now that's not too shabby, but now looking at this situation, after making this switch in contributions, just this one little tweak 30 years down the road has quite the impact on the portfolio. Sure, the main account's going to be valued less and will be generating less dividend income, but the Roth IRA in value and in dividend income will almost double. And overall, with both of these combined, we're looking at a total portfolio value that's about $270,000 higher than the before situation, and I should end up with about $8,000 more in dividend income. Not only that, but the taxable income goes down from 76% to now only 58%. So we're saving a lot on taxes when it's all said and done. Now, not only will this change result in a larger portfolio and more dividend income down the road, but it'll also create a better balance between my taxable brokerage account and my Roth IRA, and overall will create more ample diversification. You see, right now my taxable brokerage account makes up about 90% of my combined portfolio value, but down the road, based on the figures we saw, I'll end up with a much better balance between these two portfolios, which will be great because not only will I benefit from more tax-free dividend income and tax-free gains from the larger Roth IRA, but I'll also be able to take advantage of the flexibility that's offered by that taxable brokerage account. Let's say hypothetically that somewhere between here and 60 years old, I wanted to start pulling some of my dividends. Well, because that taxable account is still getting funded and is still growing, when I'm somewhere in my 40s, I still should have a pretty respectable amount of passive income there to use without penalty if I wanted to. Another cool thing about this is that the two ETFs I have in my Roth IRA, which are SCHD and VU, will start to become a considerably larger percentage of my overall portfolio, and soon they'll actually be my largest holdings. Now, having said that, what does this mean for the taxable account? Am I throwing in the towel? Am I calling it quits on picking individual stocks? Absolutely not. In fact, I think this move will allow me to do even more of that, because since I'll be more diversified through the ETFs, I may feel better about consolidating even more in my taxable brokerage account and reducing my number of holdings even more there, which means that I'll have less companies to keep up with, which means that I can spend more time researching potentially new investments instead of keeping up with all of my current ones. That's something I'm very much looking forward to. And with that said, check out this next video to find out which stocks are on the chopping block in my portfolio right now. I'm planning on selling out of all 4 of these stocks, and I've actually already sold out of one. But anyway, click right over here to find out which ones they are, and I'll see you in the next one.